Across the global physical commodities market, a persistent structural inefficiency exists. Suppliers consistently extract high-value raw materials, like gold, but lack the immediate capital reserves required to securely transport and settle these assets at premium global hubs. Without the liquidity to access institutional pathways, these suppliers are bottlenecked. To maintain operational cash flow, they are forced to liquidate their physical inventory through localized, fragmented networks. This creates a severe financial penalty. Because they cannot reach top-tier refineries, suppliers must sell their inventory at steep discounts to the global spot market price, simply to move the asset. Secured trade finance injects private capital directly into the origin of these physical transactions. By funding the logistics and assay process upfront, capital providers shift the execution pathway from local liquidation to institutional settlement. The commodity bypasses the fragmented local networks. It moves in a controlled, fully documented chain of custody from the point of extraction directly to sovereign or institutional buyers in major settlement hubs like Dubai or Hong Kong. Goldbridge operates precisely within this arbitrage. It is an origination and execution platform built to deploy capital into these specific, secured global trade flows. To understand how this generates yield, we need to map the physical transaction mechanics, analyze the temporal strategies across different global corridors, and look at the underlying Layer 1 architecture that scales the entire system. Bridging the physical gap between extraction and premium settlement converts the distressed pricing of unfinanced commodities into a protected, repeatable cash flow engine for the capital provider. The platform operates on a trackable 5-step cycle. It begins with capital allocation, where funds are ring-fenced to finance a specific transaction. That capital executes the asset acquisition. The gold is procured directly from the supplier at a pre-negotiated discount to the spot market price. Next is logistics and delivery. The physical inventory moves via bonded carrier under a strict chain of custody protocol to a primary global hub. Upon arrival, the commodity undergoes independent third-party assay. This physically verifies the exact weight and purity, generating the final compliance documentation. Finally, settlement and exit. The verified gold is sold to the institutional buyer, and the original capital, alongside the agreed yield, returns to the financier. The yield generated by this sequence is derived directly from the margin spread between the acquisition cost and the final settlement price. Look at this unfinanced pathway. A supplier forced to sell locally takes a heavy penalty, liquidating at roughly a 5% discount to the spot price. With Goldbridge financing the logistics, that same gold accesses premium institutional buyers, where the sale executes at a 0.5% discount. The difference between the distressed local price and the premium institutional price creates a net spread of roughly 5.5% on every kilogram traded. Throughout this entire sequence, the capital remains backed by the physical inventory. The steep discount secured at acquisition serves as an intrinsic buffer against market volatility. Institutional financing removes the supplier's logistical bottleneck, capturing the value of that former distress penalty as a structured, quantifiable return. This transaction architecture is applied across different global supply networks, creating distinct temporal profiles. The first is the Africa corridor. Operating out of West and Central Africa, this corridor processes a consistent volume of 250 kilograms over a single 30-day execution cycle every month. The defining feature is the fixed purchase price. The buy-side cost is locked at $125,000 per kilogram at the source, neutralizing base volatility. If the spot price dips below this fixed threshold, the transaction does not execute, acting as a floor to prevent capital loss. But if the spot price holds or rises, the upside is uncapped. At baseline, the 250 kilogram volume targets roughly $5 million in gross profit. Every dollar the spot price increases expands that margin directly. This structure requires rigorous oversight. The corridor relies on established Kenyan supplier relationships, moving exclusively via bonded carriers to designated settlement hubs. Combining a rigid 30-day duration with fixed downside protection, the Africa corridor functions as a highly stable, repeatable baseline asset within the broader portfolio. In contrast to Africa's monthly stability is the platform's high-frequency engine, the Thailand corridor, a supply network executing on rapid, daily trade cycles, possessing the infrastructure to scale up to 500 kilograms of physical gold every single day. Instead of a fixed fiat price, the Thailand flow operates on a floating metric, securing a strict 6% discount against the live spot price at the exact moment of acquisition. This daily flow requires agile execution. Depending on which institutional buyer offers the most competitive rate on any given morning, the physical shipment is routed for same-day settlement in either Hong Kong or Dubai. When that 5.5% net spread is applied to a 500-kilogram daily capacity, the mathematics shift. Operating over 100 cycles in a single quarter, the margin transforms from a single transaction metric into a high-frequency sequence of returns. Because this corridor relies on active market pricing, it utilizes an opportunistic standby model, activating strictly when the spot price hits the required margin threshold. Plotting these two models reveals distinct temporal signatures. On the left, you have the steady, high-volume 30-day block allocations of the Africa flow. On the right, the rapid daily spikes of the Thailand execution. When capitalized simultaneously, they merge to form a cohesive yield curve. The stable monthly returns anchor the base, while the daily velocity drives rapid scaling. Balancing cycle durations allows capital to maximize total trading velocity without sacrificing the underlying physical asset protections. This system demands continuous motion. Once a specific physical cycle settles and capital is returned, it is immediately targeted for recycling into the next available pipeline. The mechanism of recycling creates a continuous origination engine. By immediately redeploying settled funds into the next qualifying corridor, the platform converts single-deal returns into a compounding capital flow. Managing this volume introduces a massive operational burden. Tracking the physical chain of custody, maintaining compliance, and routing rapid settlements across international borders requires absolute precision. To process this throughput, Goldbridge integrates a purpose-built Layer 1 blockchain network directly over the physical logistics loop. Every movement, from secure transport to final refinery intake, is digitized and verified on an immutable ledger, ensuring exact asset provenance across international borders. This automates the transition between verification and payment. When the independent third-party assay confirms the purity, a smart contract triggers the release of funds and distributes the exact proportional yield. Digitizing the execution removes the traditional bottlenecks of global finance, allowing allocators to seamlessly scale their participation as new supply chains come online. This underlying architecture is not restricted to the gold trade. The precise logistics tracking and trustless settlement mechanics that secure physical gold are natively designed to process any highly liquid, verifiable asset. This same framework is adaptable to energy markets. By replacing refinery assays with IoT-integrated flow meters and port-side quantity sensors, the platform applies the same ledger-based verification to oil and gas trade flows. Capital can move between these distinct asset classes through the same standardized settlement pipeline. The Layer 1 architecture provides the common language needed to fund disparate global commodities under one risk framework. By fusing proprietary Layer 1 ledger technology with hardened physical logistics networks, Goldbridge provides institutional capital an entirely modernized architecture to capture real asset yield.